And our next guest speaker right now, as we say, save the best for last, is Ant Sedgwick, Portfolio Manager of the Rainmaker and the Entrepreneur Fund. Over to you, and we'll have a Q&A afterwards.
Great, thank you very much. Good morning, everybody, and thanks for the opportunity. I'm sure you've heard a lot already from many other speakers this morning about the Ukrainian war. So the title of the presentation is The Butterfly Effect and the Law of Unintended Consequences, two subjects that I'm particularly interested in. Now, I'm sure you all know what the butterfly effect is. I'm not going to bore you with the historical background around where it came from, but essentially, as you will all know, it refers to small move somewhere in the world can have dramatic and concentrated and exacerbated effects elsewhere, just simply through the process of compounding and spreading. And we're seeing that through the events of what have happened in Eastern Europe over the last nearly 2 months now. Now, the big unanswerable question, I would say, is, how long is this conflict going to last? We can all speculate about exactly what Vladimir Putin's motives are, whether it is justified on the basis of concerns or security concerns around the Ukraine joining NATO. Personally, I think that's extremely unlikely, and I think it's far more motivated by his aggressive ambitions from a territorial perspective. But I'm not going to speculate on that. We're unlikely to be right, and I don't think by getting to the answer we get, it helps us, particularly from an investment perspective. The second question, of course, is how long will it last? Clearly, the conflict won't last forever, but it could last a very long time. I mean, look how long Russia took to realize that it was going to fail ultimately in Afghanistan. I think it was a couple of decades. So we could be in for a guerrilla-type existence that may last a substantial period of time. But ultimately it will end, and so the question is how quickly. We think for the time being it's more likely to be a more protracted thing. And then the next question is, how quickly will we see Russia reassimilated into the global economy? We've certainly seen an incredibly quick and aggressive reaction broadly from most Western nations and expanding to many other countries in the world. South Africa, rather embarrassingly, I would say anyway, sits on the fence. And so we've seen a very aggressive move and a very quick move. And I think it's pretty unlikely that you see those get unwound as quickly as they were imposed. We can certainly speak from some experience here in South Africa. If you look at all of the sanctions were imposed on our country for many years, it took a couple of decades, even post our democratic transition, for some of those tactically, legally to be removed. So I think as quickly as they've been imposed, they don't get withdrawn as quickly. And then the question is, what are the permanent consequences of these events likely to be? And this is, in many respects, not really the first derivative question, but the third and the fourth and the fifth that are probably beyond our understanding still at the moment. Now, some highlight stuff, which I'm sure you might be aware of. The combined Russian-Ukrainian economies are about 2% of global GDP. It makes them a 1/12 of the size of the US, but it's considerably bigger than South Africa. Oil and gas and the impact there have been the primary headline gathering events, and we've seen the extent to which those have occurred. But I think those are the obvious things, and I want to look beyond those today. The combined economies, you can see are very big in palladium. I'm not going to talk about that. It's a very obvious situation, and for the time being, that commodity continues to be exported and hasn't had substantial limits put on it, although we saw an announcement from the LSE last week around some changes there. Oil has been particularly headline grabbing, as well as natural gas, because of the provision of heating fuel to Western Europe and the impact that has had. But there are many others as well, and And specifically from a food perspective and a food safety and security perspective, there's been some very dramatic effects. You can see the chart on the bottom right-hand side. It shows Russian and Ukrainian contribution to global exports, the global export market or the seaborne market for the provision of a variety of soft commodities on the right-hand side. And you can see in many of these wheat, corn or maize, as we call it here in South Africa, and barley, and the impact that, with a big input into the liquor industry, particularly beer. Very, very big contributors and have a massive impact. Now, we haven't really seen the effect of this yet because it's been winter. But clearly the plantings for the year ahead in Russia and the Ukraine for these commodities are going to be substantially reduced. Certainly in the Ukraine's case, may practically go to zero. And the ability to export, given that the ports are largely landlocked. I was reading an article, many of them have been mined now. So even the ships that have taken on loadings physically can't get out of the maritime space because parts of the Black Sea are now mined. Now this has a huge impact in particular on many poor countries. If you look at the chart on the bottom left, you can see where does Russian and Ukrainian wheat go, that exported product. You can see Egypt is a very big consumer. So if you look at a country like Egypt, practically all of the wheat that they consume is coming from these two countries. 30 and 40% of their tourism industry are Russian and Ukrainian holiday makers. So this is an economy that is going to find itself under very extreme pressure. There are many poor countries who produce absolutely no wheat and who source 100%, or nearly 100%, of their wheat and grain only from the Russia and the Ukraine. Now that number will go practically to zero over the course of the next year, and the ability to substitute it elsewhere is extremely difficult to achieve in the short term. So what we are going to see is the cost of goods or the cost of production given that these soft commodities go into such a broad range of consumer products, is going to have a tremendous impact on inflation. And the second point I'd like to make is, while we have seen that inflation, if you look at the chart on the bottom right, the sort of light brown and the white line are the price of barley and wheat, and you can see those are up about 70%. But the green line is fertilizer, and you can see that's up 250%. This is a massive input into production. We've had some anecdotal discussions with South African maize farmers over the course of the last 2 weeks. Although the maize price is very high, the benefit to them has been completely negated by the impact of fertilizer prices and the cost of diesel fuel. So, all of this is going to be passed on ultimately to consumers. It's likely to result in substantially lower yields, and it all adds up to a pretty negative outlook. And we would expect that this is likely to evolve into social instability in countries. We've already seen riots. This is from last week's New York Times in Sri Lanka, where we've already seen rioting, exacerbated by political problems in that country, but largely based on what they've already seen in terms of staple goods inflation and the impact that's having on people. It's also not all about soft commodities, and it's not all about oil. If you look at this chart, the white line is the oil price, which we can see these are all based to 100 going back about 2 or 3 years, and you can see the oil and wheat price are up quite substantially. The green line is copper, which you can see has been reasonably strong, but the purple line is the thermal coal price, which I think the previous speaker was talking about as well. Has really, on the back of natural gas, on the back of very little investment made into thermal coal because it's been this ESG pariah that nobody's wanted to touch, and has absolutely gone through the ceiling. And we've seen that in some of the equity prices we've had some exposure to. And then all of this feeds through into inflation. So this is looking back 5 years. You can see this is French as a European proxy is the green line. The white line is UK inflation. The yellow line is US. You can see was in a very narrow band, below 3% for a very long period of time, and it's absolutely blown through that. It's clear that inflation is not just transitory, and this is before the print that we saw like last week of the US getting to 8.5%. From a Rainmaker perspective, I just wanted to highlight a couple of particular, specific positions where the fund is quite aggressively focused. You can see we've got nearly 8% in Anglo American. This has been a real winner for the fund. The red line just shows the share price appreciation from a very, very difficult position about 5 years ago when the firm was teetering on the verge of a rights offer. Has repaired its balance sheet very substantially, focused its portfolio. If you look at the pie chart on the right-hand side, that's the copper equivalent production of what this firm produces. Some of these commodities still coming off quite a low base, so the diamond part of the business, profits are still coming off a relatively low base. I admit the PGM's looking a little bit higher, so we don't own as much direct platinum, but copper, we're still very excited about. We think there's huge upside still there. Plus, we've got volume production coming out there. And interesting to note that their fertilizer business, that some market commentators were quite negative about when they made that acquisition of this polyhalite deposit, which is in northwestern the UK, of all places. Not the most obvious mining jurisdiction that one would think of. But really, in the context of the slides I've shown you earlier, is a very interesting angle of optionality in the Anglo's mix. They've unbundled the thermal coal, or the bad ESG part of the business, and shareholders who've held onto that Thungela position have obviously done tremendously well in the short term, and they retain the met coal, which is, from an ESG perspective, considered less offensive. But putting all this together, despite the strong growth in the share price that we've seen, you'll see the green line, which is the PE ratio on the right-hand axis, is just on 8 times, with some tremendous growth we think still ahead for parts of this portfolio. We also have a big position in Shell. We prefer Shell rather than Sasol. We can spend a long time going into the issues the controversial issues that it faced here in South Africa around some of their seismic testing, but this is a very big business. We've engaged with the firm directly on the matter. You can see, notwithstanding the run in the share price that we've had, the valuation is still at an extremely attractive level. And this is an organization that, from an ESG perspective, is very much on the front foot, whereas we think Sasol is a business that faces terminal problems in that regard. Mondi, on the right-hand side, also a key position, clearly negatively affected by the Russian sanctions. 20% of their operating profit comes from their mill in sort of central north Russia at Syktyvkar. They're walking a narrow, balanced of tightrope there between doing the right thing for the business, doing the right thing politically, and doing the right thing around this very remote community of only 60,000 people, which their facility pretty much entirely supports. In fact, they're the only producer of electricity for that community and are legally obliged to continue to do so. The valuation, we think, is a little overdone in the short term, and so we've continued to hold quite a big position in that key pick, but it's hurt us in the short term. Just wrapping up on Rainmaker then, if we look at the sort of some of the key picks, both on the domestic and the global side, the table on the right-hand side, and the difference between Q4, the end of Q4 last year, and the end of Q2 of this year. You can see there the dramatic underperformance of NUSPAS process combination. I'm not going to get into a long diatribe about that, but suffice to say that it's a massive thorn in our flesh. All of the remaining positions in the fund have had very good runs. We've taken a little profit out of the MTN position, which you can see remains quite a material one. Mondi I've discussed, and you can see the underperformance reflected there in the change in the weightings. And on the global side, we've had a tremendous headwind from the rand over in the year to date. But the only stock that we've disappointed in the performance of over the quarter was Samsung, which has just produced an excellent set of results, and we're hoping that we'll see some re-rating of that during the course of this year. The last key themes, I'm not going to run through these all. I think I've covered some of them all. Very pleasing to see British American Tobacco as a key pick, having produced excellent results for the 2021 year and reinstituted the buyback. That re-rating of that business has started. We think there's more installed in the year ahead. We've got key local industrial picks, very specifically chosen, but very little in the domestic consumer side of things, where we continue to expect some pressure. And we would hope that the headwind that we faced from the Rand in Q1 may dissipate going into Q2 and Q3 and Q4, although we note that South Africa has suddenly become a substantially less unattractive emerging market in the context of what's happened with the behavior of many of our EM peers, obviously notably Russia and Turkey since we last spoke a quarter ago. I'll pause there and see if there are any questions, Andile.
And thank you so much for that. That was very informative. I do have a couple of questions. They just keep on coming in. And the first one is on soft commodities. I know you touched on it, but someone would like to know here how soft commodity prices may affect food producers and retailers here in South Africa. And I know that your preferred ones are Shoprite and AVI Limited. Maybe if you can just touch on that for us.
That's right. So we're expecting a very high level of inflation, which these businesses will be forced to pass on to consumers. So, expect the price of bread, and it's not just going to be in bread. You're going to see it in rice, you're going to see it in pasta. So across all, carbohydrates. Again, that feeds in as a raw material feeding into a lot of other consumer products. So we're expecting high inflation. We expect the domestic South African consumer already under pressure to see those household wallets feel that pressure. We think a business like Shoprite, although it's pretty expensively priced and has had a great run, is the net winner in all of this, in that it appeals to everybody, and so it benefits from people buying down. We think it's ahead of the pack on its direct-to-consumer channel of distribution. AVI, again, is going to face headwinds. It's biscuit business. They are going to have to pass on those price increases. So there are headwinds, and that's why, overall, although we have some domestic consumer exposure, it's pretty limited in the portfolio at the moment.
Thanks for that. I just want to jump on now to some global stocks. I know you have Garmin. You've recently added Garmin and L'Oreal. What was your thinking behind those?
I'll leave Steve to talk about Garmin. Maybe we can do something next quarter. But L'Oreal is really an outstanding. It's one of the global long-term winners. It's a stock we've had on our bench for about 4 years now. We followed it really, really closely. And what we've seen in this last quarter is a big sell down. We've seen it in the luxury space. So it's hurt us a little bit on one of our key picks. There was a company called Moncler, but it's given us an opportunity for the first time finally to be able to buy a stake in a business like L'Oreal, which we think is a great long-term winner. It's going to compound for many years and was always just a little bit too expensive for us. But with this big derating that we've seen of some highly rated global businesses in the first quarter, it's given us that opportunity to buy it for the first time. Great. Maybe for next time we'll do a special edition, a deep dive into one of these stocks.
We'll definitely do that. Just as a final question and bringing it back home now, we have a sizable exposure to Santam in Entrepreneur Fund, and with the floods that's happening in KZN and now recently Eastern Cape, how does this affect your valuations in terms of companies like these?
Yeah. The short answer is it doesn't, because in the long term it all works itself out. However, it is undeniable that there's going to be some damage from the floods in KZN. We've seen a phenomenal run from the stock. It was trading about 220 about a year and a half ago. It's run up. It's actually just paid a special dividend. So it's just about 2 weeks ago paid its ordinary and special dividend, was about 16 Rand a share in total. So in the context of what happened last week and the size of that big position in Entrepreneur and the good run that we've had and the fact we've had our dividend, we actually sold quite a lot last week. but we still think it's an outstanding business. And really, short-term insurance is one of our sort of core positions across the fund. We've got the RMI unbundling this week, so we'll get our OUTsurance shares directly, which we're definitely going to be hanging on to. So, short-term insurance as a general category is a big part of the fund, but we did reduce it last week in the face of as an opportunistic thing in the context of the invariable hit they're going to take on the losses, particularly on motor and property in KZN, and the very strong run we've had in the short term out of the stock.
And well summarized. Thank you so much for your time. We do really appreciate it. It was good having you here.
Thanks for having me.